What's going on, everybody? It is Tuesday, November 29th. Congratulations to the U.S. soccer team. Now they advanced to the second round, the knockout round of the World Cup after beating Iran today 1-0. And if you watch the game, it was a nail biter, especially at the end. We had 9 minutes additional stoppage time, so that last night, after the 90-minute regulation time, we had 9 more minutes to go, and I was on pins and needles. It was a nail biter, but the U.S. advances. So congratulations to the U.S. team. All right, we had a mixed day today. Dow closed positive, NASDAQ, S&P down slightly. I want to talk about something which I think you may find interesting. And it goes back to, this is a topic that I touched upon several times during the pandemic. And specifically related, I'm going to speak about it today, specifically related to oil. By the way, just on a side note, we got the API inventories. Oil was up today, and it's been kind of in a downtrend now since since June or September. I have to go back and look at the chart. I think since June. It's been in a downtrend, but it was up today, and we got the API inventory report just a little while ago, and that showed a pretty big draw, almost 8 million barrels in the latest week. Tomorrow we get the EIA data. But here's what I want to talk about. And for those of you who have been following me in this channel for any length of time, you may recall the conversations I had on this, or the videos that I did on this subject. During the pandemic, and that was of course a period where the Fed was keeping interest rates very, very low. They were engaged in quantitative easing. So monetary conditions were they term it loose, whatever, but more importantly, their interest rates were basically at zero. And I was saying at the time, because, commodity prices were skyrocketing, and at first the Fed, Powell and Janet Yellen were saying it's transitory. And I stuck by that. I said it is transitory because it had to do with the supply chain disruptions that was caused by the pandemic. And I was saying at the time that nearly every single commodity market, if you looked at the term structure, in other words, the contracts going out over a period of time, they were all in backwardation, meaning that the nearby contracts, the spot months, the most immediate contracts for delivery, they were trading at a premium, and in some cases a record premium, to the deferred contracts. And this was understandable because you had the supply chain disruptions. There was almost a complete inability in some cases to procure these commodities. Demand was strong. The supply wasn't readily available, so prices were being bid up. But I said, if you looked at the term structure of these markets, nearly all of them, okay, they were all in backwardation, meaning that the deferred prices were much lower than the nearby or the spot prices. And I said at the time that the markets were telling you, giving you a signal, giving the Fed a signal, transmitting a signal to everybody that future prices of these commodities are going to come down. This was the clearest and most obvious signal that the situation was transitory, okay? And that remained the case until recently, when the Fed this year started raising interest rates. They raised it in March, they raised it in May, right? They raised it in June, they raised, July, and something very interesting happened. The term structure, and especially now I'm talking about oil, flipped. It went from backwardation, meaning again that spot prices were way above the deferred contracts. Now it's in what's called a contango, where spot prices have fallen below the deferred contracts. And this is, I think it's very telling, because it shows you that the rate hikes are increasing term premiums. In other words, forward premiums, forward pricing for commodities. The markets now, just like they were telling us back during the pandemic that it was a temporary situation, that prices would eventually start coming down, which actually happened, they're saying the opposite right now. That prices in the future, and I'm talking about oil right now. I didn't have a chance to look at other commodities. I'm going to check that out. And I wanted to put up some charts and some, some tables, some price tables so you could see it. But you can go check that out. If you go to the CMEgroup.com, or if you go to barchart.com or look up these commodities, you could see the term structure. Bar chart has spreads. You could check those out. So this is, once again, like yesterday I talked about how Bullard, James Bullard, the St. Louis Fed president, just doesn't understand basic arithmetic about how the rate increases are going to significantly increase income transfers into the economy via that interest rate channel. And, that's not spending that's going to creating new real assets or more productivity. That's just checks going out. And that's not, that's not a strategy for reducing inflation. And again, we have the example here of the recent turn in the term structure of these commodity markets. I'll use oil. Oil, obviously I'm citing oil right now. And oil, by the way, we can't ignore it because it's a very economically sensitive commodity. The term structure has flipped dramatically, I have to say, where the forward prices, at least through basically the first 4 months of next year, are predicting higher prices. And that it's just now starting to predict higher prices. But again, this shouldn't be hard to understand. Okay, I've said this so many times that the cost of credit is reflected in the cost of all goods and services. When you raise the interest rate, it raises the holding cost of that commodity, right? Because to store it for the future, there's interest, there's storage charges, all those things go up. And you could see it very clearly. Rate adjustments are reflected very clearly in the term structure of commodity markets. When rates go down or when they're low, like they were during the pandemic, you had backwardation, which basically said that prices were either going to stay stable or go down. And when rates are rising, you see a positively sloped term structure or price curve of the commodity, reflecting the higher cost of that commodity in the future, because it becomes sequentially more expensive to hold. And this is exactly what is happening right now. Now, this is basic understanding. This is another thing that I can point to where I would question why these people, again, highly educated, and by the way, Bullard, I checked out his resume. He went to University of Indiana or something like that. I'm not knocking University of Indiana, but I said yesterday, all these people went to like Harvard and Yale and Wharton and stuff. He didn't go there. Not that that means anything, all right? I'm sure you got a fine education over there, and he did, I think he did some graduate work somewhere, I don't know. But the point I'm making is, you can see the effects. It's another one of these examples where I'm saying, well, look, you got Japan on one hand, which has kept interest rates at zero or negative and has very little inflation, even though it is entirely dependent on imported oil, which has, spiked up like crazy. Even with the pullback right now, man, it's still historically high. Okay? and their inflation is like negligible. And then you have a situation, you have an example like Argentina where rates are at 75% and inflation is at 100% annually. These are clear examples that anyone could look at and at least question the theory that these rate hikes are the strategy to deal with inflation. And now you have another clear example, which is the term structure of commodities, which to me it's so mathematical. I mean, the Japan situation, the Argentinian situation, you could argue, I guess if you want, you could argue that there are unique circumstances in those things that create those conditions, right? There's maybe unique circumstances in Argentina that create the high inflation, maybe debt denominated in a foreign currency like US dollars. You could say something about Japan. I mean, that wouldn't be correct. It wouldn't make it correct. But, if you wanted to play like, like have a debate, verbal jousting back and forth, you could come up with something that sounds reasonable. But in the case of the term structure of commodities, that's just a mathematical formula. Like if you're in the commodity business and, you own physical oil and you want to store it and you call a storage facility, they will quote you prices depending on the term that you want to use their storage. You want to use it for 3 months, you want to use it for 6 months, you want to use it for a year. And that pricing includes, the interest rate. So like when the interest rate is low or declining, you tend to see the forward prices come down or stay flat. And when the interest rate is rising, you tend to see, that the cost of storage, the forward pricing, go up. I mean, it's very fundamental. It's very mathematical. That to me, a lot of these guys, they pride themselves. When I say this, a lot of these guys, I mean like these academic economists, especially nowadays, because they pride themselves on like trying to turn economic forecasting into a form of math, like applying math to it, okay? Like it's become very quantitative. Not that these models really work very well, but I mean they pride themselves on these really, really sophisticated mathematical models, but it's right there. It's like I said, I know I spoke about this like I think last week. I said when I was talking about the inflection point between the negative impact of interest rates on a financial asset, okay, there's an inflection point where the negative impact gets offset by the positive impact of cash flow. Like if you look at net present value, which is like, discounting the value of something in the future, what is it worth now? When you look at that, there's two variables in that equation. There's cash flow and there's the interest rate. Now, the first thing to impact that financial asset is usually the interest rate. It takes time for that cash flow to generate at a high enough level to offset the immediate changes in the interest rate. But that's like a mathematical formula. It's not like I sat here and I say like, oh, I think, this is going to happen because, it seems to me to be logical. No, I mean, that's if you want to use their approach, which is a formulaic approach, it's right there. I mean, the initial impact is the discounting impact from higher rates, but then you have higher cash flow from that net injection of income into the economy. People spend some of that. Same thing here. I mean, you have the slope of these commodities. It's not just like some kind of a random thing. Like, you could see the correlation. You could see the how rate adjustments affect the slope of these commodities. But again, they don't pay any attention to that. But anyway, so what I wanted to point out was I think we're bottoming here in oil. I think the flip into contango, and again, this is not a trading signal per se. I mean, because it takes time for to see the how this kind of plays out. It took time for oil prices to come down, but the market was telling you that. I mean, I was a trader on the NYMEX back in the 80s. We used to play these spreads all the time, these time spreads. And interest rates were a factor. I mean, not that I understood it back then. Believe me, back then I wasn't an MMT adherent. I was very unsophisticated, even though I have a degree in economics. But that didn't mean shit. I mean, I was just I was a floor trader like everybody else, just like trading from the seat of my pants. But we did trade these spreads, and there were some guys down there, I have to say, I remember some of these traders down there who focused solely on trading these spreads, and they were really, really good at it. And they were really, they held these huge spread positions, and they were just cranking out money month after month after month. I mean, that really was the play. But they understood it. I never tried to emulate them or copy them. I was stupid. I guess I should have. But, my game was just the flat out straight speculator game, buy or sell, Anyway, there it is. We've seen a very dramatic change in the term structure of oil. It is now in contango. Again, the definition of contango is that futures prices, forward prices, are now higher than the nearby prices. And the market is sending this signal right now that prices in the future for oil are going to go up. So if I was going to give a strategy for you on this, you want to be a buyer, on dips, oil stocks, energy stocks, at least with a time horizon, I would say into like April of 2023. It's very interesting too. I have to point this out, that the term structure right now in crude, if you look at it, it exactly mimics or reflects Fed policy going out to basically until like January 2024. I mean, raise, then flat. They stop raising. I mean, that's another thing. Like you think they would look at that like, look, commodity prices are exactly mirroring what we intend to do, or what the market expects the Fed to do. Okay? The Fed is expected to raise rates this month. They're going to raise rates again in February. They're going to raise rates in March. I don't know. I got to look at the Fed funds futures again to just see how far out. But then it goes flat. Then they stop. And that's exactly, if you look at the curve of crude, that's exactly where the contango stops. It's telling you. It's telling them. And I'm telling you. So you see, you don't got to be a math genius, coming up with these just arcane equations that they get so deeply buried into this stuff that they just, what's that saying? You miss the forest through the trees. So there it is. There it is. I mean, the market is trying. I'm going to go look now at some other commodities. I'm going to look at copper, other economically sensitive commodities. Going to look at wheat, right? Going to look at, some of these agricultural commodities that you can store, corn, stuff like that. Yeah. So there you go. Anyway, that's it for today, folks. See you tomorrow. Bye.